to 6 we have covered so far. So let's move towards one important and lengthy chapter of our syllabus. There are two lengthy chapters, chapter 2 and chapter 7. Chapter 7 is about company law. The name of chapter 7 is corporation, mean company, and legal personality, mean what are the legal requirements for a company. So corporation and legal personality mean company is a separate legal entity. Separate legal entity mean artificial person in a society. The asset of company are the asset of the company rather than owners mean shareholder. The liabilities of the company are liabilities of company rather than owner shareholder. If any person is having any link with the company, they should be having a contract with the company name rather than owner's name. So let's move towards the first concept, the doctrine, mean philosophy, and the wheel of incorporation. Wheel of incorporation means separate legal entity. Wheel of incorporation means separate legal entity. In company is a separate legal entity. The company is a separate legal entity, i.e., separate from its shareholder, the part owners, and its directors and managers. The asset of company are asset of company, liability of company are liabilities of company. And there is a case, Salman versus Salman and Company Limited. S transferred his business to a limited company. He was the director and majority shareholder and are secured creditors. So S is also a majority shareholder of the company. He is also a director, meaning employee of the company, and he is also a secure creditor of the company. The company went into liquidation, and the other creditors tried to obtain repayment from S personally, because you are the major shareholder of the company, so you need to pay our debt. Can other creditors ask S to pay debt? No, because S is a separate, company is separate. In sole trader or partnership, obviously business is with the name of owners. But in a company, owner separate, company separate. So other creditors cannot sue the owner. They can sue the company to recover their. How they can recover? By selling asset of the company. So court decided S as a shareholder and director had no personal liability to creditors and he could be repaid in priority as a second creditor because he is a secured creditor. This enshrined the concept of separate legal personality and limited liability in the law. Company is a separate legal entity. Company is having limited liability, mean owner's liability in the company is limited up to the amount of shares they have invested. And there is another case, Lee versus Lee's Air Farming Limited. This case concerned an aerial crop spraying business. Aerial crop spraying business mean by using aeroplane, they put spray on the crops. This is the business. Mean they provide services to different farmers. What kind of services? Through aeroplane, they spray over the crops. Mr. Lee owned the majority of the shares, all but one, and was the sole working director of the company. He was killed while piloting the aircraft. He was a director of the company as well, and he was a major shareholder as well. And he was killed while performing his duty as a employee of the company because he used to drive the airplane. Although Lee was the majority shareholder and sole working director of the company, I mean, what happened? His wife, his widow, claim against the company for damages because her husband was employee of the company. And while performing duty, he was killed. So they can claim compensation from the company being an employee. So although Lee was the majority shareholder and sole working director of the company, he and the company were a separate legal person. Therefore, he could also be an employee, and being an employee of the company for the purpose of the relevant statute with the rights against it was killed in an accident in the course of his employment. Meaning he was killed in the course of employment. So company need to provide compensation to his. So there is another case, Makara versus Northern Life Assurance. M owned a forest. He formed a company in which he beneficially owned all the shares and sold his forest to the company. Me M formed a company and he sold his personal forest to the company. Mean who is the owner of the forest now? Company. He, however, continued to maintain an insurance policy on the forest in his own name. While the insurance of the forest is with M own name rather than company name. The forest was destroyed by a fire. And he tried to recover from the insurance company. But the court decided the forest does not belong to you. You, as a separate person, cannot claim insurance claim from the insurance company because that forest is not in your ownership. It is in the ownership of the company, and company is a separate legal entity. And insurance is not in contract with the company. So you cannot claim insurance for any asset that doesn't belong to your ownership. So he could not claim on the policy since the property damaged belonged to the company because company is a separate legal entity, not him. And as a shareholder, he had no insurable interest in the forest because who is the owner of the forest? Company rather than you. If you are having insurance policy of any asset that doesn't belong to you, you cannot claim insurance for that asset. Consequences of incorporation mean what will be the outcome being a company separate legal entity. There are a number of consequences of being a separate legal entity. Limited liability means owner's liability is limited up to the amount of investment. In case of losses, their personal property will not be used to pay off debt to the company. A company is fully liable for its own debts. How company can pay debts? By selling its shares. If a company fails, the liability of the shareholder is limited to any amount still unpaid on their share capital or amount they have agreed to contribute if the company is limited by guarantee. What is company limited by guarantee? We're going to discuss later on. Mean owners are liable up to the amount of investment. Suppose they have bought a share for 100,000. Out of this 100,000, they have paid 70,000 to the company, 30,000 still unpaid. Their liability will be not only this, complete ownership, not more than this. The consequence is that a company's member have limited liability for its debt, give a protection to the members, mean shareholder, from the company's creditors and from the risk of business collapse. A company enters into contract in its own name and can sue and be sued in its own name. Creditors are bodies who provided debt to the company. They cannot sue owners of the company if company is not paying their debt. They can sue to whom? Company. A company owns its own property. In asset of the company or asset of company rather than owner. A company has a perpetual succession irrespective of the fate of a shareholder. The shareholder will keep moving, will keep changing, but company will remain same. With the change of shareholder, company will not change. Company will remain same, will continue. Even shareholders are coming in, going out. There is no effect on the company. In case of partnership, if one partner leaving the business, partnership will collapse. Now, other remaining partner or new partner, they need to sign a new partnership agreement. But company is a perpetual succession, mean will be continued, will not be affected with the change of shareholder. The management of company is separated from its ownership. Who are the management? Directors. Who are the owner? Shareholder. The company is subject to the requirement of Companies Act 2006 and Small Business Enterprise and Employment Act 2015. Mean company will be run according to Companies Act 2006. Partnership will be managed according to Partnership Agreement 1908. Where a company suffers an injury, it is the company itself that must take the appropriate remedial action. This is known as the rule in Foss versus Harbottle. What was the Foss versus Harbottle case? Two minority shareholder initiated a legal proceeding against, among other, the directors of the company. The director did something wrong. Due to that, company suffer some losses. So some of the minority shareholder, they file a suit against the directors like they didn't behave properly. Can they sue directors? No. You can sue company rather than directors. They claimed that the directors has misapplied the company's asset. Who choose the director? Shareholder. The court dismissed the claim and held that when a company is wronged by its director, it is only the company that has a standing to sue. Because you appointed the director, if you want, you can change by voting against those directors. You cannot sue the directors if your investment lost in the company. To whom you can sue? Company. So this is the concept of Veil of incorporation. Veil of incorporation mean company is a separate legal entity. Asset of the company or asset of the company. Contract with the third parties will be with the name of company. Third parties can claim damages or sue for damages to the company rather than its owner or its directors, employee managers. There is another concept, lifting the veil of incorporation, mean when a company will not be considered separate legal entity, when shareholder, directors, manager, employees can be sued. Lifting the veil of incorporation. Meaning the phrase lifting the veil of incorporation means that in certain circumstances, the court can look through the company to the identity of its shareholder. In certain cases, company will not be considered separate legal entity. Third parties can sue directors, shareholder, employee managers. The usual result of lifting the veil is that the members or directors become personally liable for the company's debts. There are certain examples. There are a number of occasions on which a statute will intervene the lift the veil. Section 399 of Company Act requires accountants to prepared by a group of related companies, accounts to be prepared by a group of related companies, therefore recognizing the common link between them. What is a group company? Group companies mean where one company, say company A, have acquired more than 50% shares of company B, more than 50% share of company C. So this B and C will be called subsidiary, and company A will be called parent company, and all three companies will be called group companies. So veil of incorporation can be lifted in case of group companies where subsidiary does something wrong and subsidiary is created with the intention to do something wrong. Then not only subsidiary company, parent company will also be responsible for that. Mean subsidiary is a separate legal entity, no parent will not be able to say that. You are also liable for that. In normal situation, this is separate legal entity, this is separate legal entity, this is separate legal entity. But in case of group company, no, for his debt, you will be liable. So this is the first case, requires accounts to be prepared by a group of related companies, therefore recognizing the common link between them. Under the Insolvency Act, members, shareholder, and directors liable for wrongful and fraudulent trading may be personally liable for losses against as a result. If directors, shareholders are involved in fraudulent activities and they are using the name of the company, no, in case of any case against the company, they will be personally liable rather than on the company because they were performing fraudulent activities. Under normal activities, there is no fraud involved. In that, company will be liable. But if directors, shareholders were involved in fraudulent activities by using the company name, then they will also be liable. Mean company will not be considered as separate legal entity. Mean only company will be liable for paying debt? No. If a public company starts to trade without first obtaining a trading certificate, The directors can be made personally liable for any loss or damage suffered by a third party. If company performs certain transaction with the third party without obtaining trading certificate, this means directors were aware company doesn't have trading certificate. If third party lost something, they can sue the company as well as director will be liable for the company losses if knowingly they started trading activities without obtaining trading certificate. Under the Company Directors Disqualification Act 1986, if a director who is disqualified participates in the management of the company, that directors will jointly or severely liable for the company's debt. And if a director is disqualified, but still he is performing some transaction on behalf of the company name, third party can sue directors directly because he was disqualified. So these are the circumstances where veil of incorporation means separate legal entity concept can be removed, can be lifted. Let's discuss their detail by using different case studies examples. Case law examples, sham companies. Sham mean fake companies. Mean you are using the name of a company, but a company does not exist. The veil will be lifted only where special circumstances exist, indicating that if it is a mere facade concealing the true fact. And there is a case between Guilford Motor Company Limited and Horney. An employee had a covenant. Covenant means condition. An employee had a covenant in his contract of employment which stated that he would not solicit his former employer's customers. In employee working as a solicitor for a company, means lawyer for the company, providing some legal services. In his contract, it was written he cannot start any of the competitor business, mean he cannot misuse company customers. After he left their employment, mean after he resigned from the company, he formed a company to solicit those customers and claimed it was a company approaching to customer and not him, because company is a separate legal entity. No, in your contract it was written you will not misuse company customer contract customer detail. And if you have left the company and you have started the competitor company, knowingly I can contact this company customer and you are doing that, and you cannot say that a competitor company that I have formed, they are liable, not me. No, you will also be liable here. Veil of incorporation concept will be lifted. So the court held that the company could be restrained from competition as the previous employee had set it up to evade his own legal obligation. An injunction was granted against him and the company. The court case was decided against him. He was stopped having some contract with the previous company customers. And there's another case, Jones versus Lipman. Mr. Lipman contracted to sell his land and thereafter changed his mind. Mean he signed a contract to sell his land to any of the person, obviously to whom? To Jones. And after some time, he changed his mind. What he did, in order to avoid an order of specific performers, he transferred his property to the company. He registered the property, the company name, so that Mr. Jones cannot sue Mr. Lipson for breach of contract. But court decided no, company is not liable because at the time of a contract of sale with Jones, that property was under your name. Now you cannot say that the property is under company name. If he want to sue, he can sue to the company rather than me. He will not be able to sue to the company because there is no contract between Jones and company. So the wheel was lifted in order to prevent the seller of a house evading specific performance. An order of specific performance was granted. Mean court decided now you need to abide by the contract of selling your land to Jones. Was granted against him and the company to transfer the property to the buyer. Nationality. In times of war, it is illegal to trade with the enemy. In times of war, it is illegal to trade with enemy. According to company law, in times of war, you cannot trade with enemies. It may be possible to lift the wheel of incorporation so as to impute to a company the same nationality as its members. And there is a case between Damier versus Continual Tires and Rubbers Company. C and D. C sued D for debts owing. C was a UK company. However, all shareholders but one were German. All shareholders, if you exclude this but one, all shareholders were German. Mean if suppose companies are having 1,000 shareholders, the most shareholders, like you can say 999 were German, only one you can say was from UK. And this case was at the time of First World War, World War One, between Germany and UK. So C sued D for debts owing. C was a UK company. However, all shareholders but one were German, mean most of the shareholders were German. D argued that they should not pay the debt to German individual to prevent money going towards Germany was effort. Mean the company owners said, company said, no, we are the UK based company and Germany is our enemy. So we are having a no trade with enemy during war period. The court decided no, company is not a UK based company, though it is registered in UK. But according to ownership, company can be identified as the main major shareholder of the company, mean 999 out of 1,000 are German. So this company is also German. And if the claimant is also German, so there is no enemy relationship. So as C was German, D need not discharge their debt to C since effective control of the latter was in enemy hands, and hence to do so would be to trade with the enemy. According to code, okay, during war, it is illegal to trade with enemy. But this company, D company, is not a UK company. This is German company because majority of the shareholders are German. So there is no enemy relationship. Wheel of incorporation can be lifted in case of group companies. Group company means parent company and its subsidiaries. Although each company within a group is a separate legal entity, means subsidiary parent or separate legal entity, there have been a number of cases where the courts have lifted the wheel between a holding company and its various subsidiaries. But there are certain cases in group company where court will decide no, there is no separate legal entity, subsidiary mean parent, parent means subsidiary. They are not separated with each other from each other. This has generally been done in order to benefit the group by obtaining a higher compensation payment on the compulsory purchase of premises, mean where wheel of incorporation will be lifted in group company. The first case, benefit of group. What is that? We're going to discuss later on by using a case study, a case scenario. The second, benefit creditors of an insolvent company by making other companies within the group liable for its debt. What is that? There is a company A, mean parent company. They formed a subsidiary. Parent company formed a subsidiary company, and what happened? Subsidiary company is buying certain goods on credit basis from a creditor. And those goods buying from creditors, they are transferring to whom? Parent company. And what parent company doing? They are selling those goods. And this subsidiary company is not paying to the suppliers, to the creditors. These creditors sue the subsidiary company as well as a parent company for recovery of damages, recovery of their debt. Parent company is saying no, subsidiary is a separate legal entity. So only they are responsible. You can recover your money by selling asset of subsidiary. We are not liable for that. This is the case. In this situation, court lifted the wheel of incorporation means separate legal entity. In subsidiary is not separate legal entity. You both combinedly are separate legal. Why? Benefit creditors mean when in a group a company subsidiary will not be considered separate legal entity and parent separate. They both will combine entity when benefit creditors of an insolvent company means subsidiary by making other companies within the group liable for its debt. Because you created the subsidiary might be with the intention like I will transfer all the assets from subsidiary to parent company so that in case of insolvency there will be nothing to pay to the creditor of subsidiary. Means sometime parent company can create subsidiary like that. So in a group company, the wheel of incorporation can be lifted when it can be lifted to benefit the creditors of an insolvent subsidiary, making other company mean parent company in the group liable for the debt of insolvent subsidiary. In that case, wheel of incorporation can be lifted. What is the first scenario? Let's discuss this case study. DHN food distributor versus London Borough of Tower Hamlet, mean DHN versus LB. DHN carried on business from premises owned by a subsidiary. In DHN is having a subsidiary, and subsidiary is having a land. On that land, DHN is performing his business. The subsidiary itself had no business activities. Mean only the name of business is there, but there are no other activities of the subsidiaries on subsidiary land premises. Who is performing business? Parent company DHL. Both companies had the same director. The local authority acquired the premises compulsorily but refused to pay compensation for disturbance of the business. And local authority mean government want to use that land. And obviously, if they are using that land, they are paying for the amount of land. But this business DHN, they also claiming for the disturbance of business as well. Because you are acquiring that land on which we are performing our business. If you are acquiring, our business will be disturbed. So you need to pay claims for the business disturbance damages as well. Might be the land cost is $50,000. They are paying 50,000, but they are asking no, 30,000 are business effect you need also to pay. So the local authority acquired the premises compulsorily but refused to pay compensation for disturbance of business since the subsidiary which owned the premises did not also carry on the business. In subsidiary is having no other business, so there is no disturbance of business for the subsidiary because we are acquiring the land of whom subsidiary. The you parent company cannot claim for damages of business disturbance. So the companies were in economic terms. What court decided? No, both the companies were in economic terms, mean with mutual benefit, because the directors were same, mutually interdependent on each other, and therefore they should be regarded as a single economic entity. Mean government authority saying subsidiary is a separate legal entity, but court decided no. They combine group is a separate legal entity because subsidiary is having no other operations. Subsidiary premises are used by the parent company to perform the business. So the whole group is a separate legal entity. If business of them affected, obviously it is a business of subsidiary as well. So thus there was a valid claim for disturbance since ownership of the premises and business activities were in the hand of a single group. And this is case where wheel of incorporation means separate legal entity of subsidiary can be lifted to benefit the group by obtaining a higher compensation payment on the compulsory purchase of premises, mean where any authority is purchasing premises of any part of the group and that premises also providing benefit to other part of the group, then the combined group companies will be considered as separate legal entity rather than only that part. So in a group company, wheel of incorporation can be lifted into situation where to provide benefit to the group by using the premises of any part of the group and to provide benefit to the creditor relating to insolvent subsidiary. The whole group will be liable. There's another case, Adams versus Cape Industries. Cape was an English registered company. One of its subsidiary is a CPC. So Cape is a parent company and CPC is a subsidiary. The company incorporated and carrying on business in the United States had a court judgment against it. I mean, this company is operating in USA. I think this company was operating in UK. And this company is having a court judgment against him. Mean they need to pay some damages. It was successfully argued that the veil should be lifted between the companies so as to enable the judgment to be enforced against Cape. The Cape of Appeal said there was no special circumstances indicating that CPC was a mere facade for Cape, such as was the situation Jones versus Lipson. I mean, in that case, only CPC was liable rather than Cape because Cape was not performing business operations on CPC. Cape didn't acquire the CPC with the intention of getting some benefits. As CPC was based in USA, Cape was based in UK, so they were performing separate operations. So in case of any damages against CPC, who is liable? Only CPC rather than whole group mean Cape. So this was the concept of a wheel of incorporation and when this wheel of incorporation can be lifted. So let's move towards limited liability partnership that we have already covered in previous chapter. What was limited liability partnership? Normally, in a partnership, owner's liability is unlimited. But if you have registered your partnership as a limited liability partnership, then owner's liability will be limited up to the amount of investment only. Mean their personal property will not be used. Mean this is similar to our company. So ordinary or general partnership lack the characteristics of company in the sense that they do not have limited liability because general partnership is not separate legal entity. Asset of the partnership business are asset of the partners owners. Liability of the partnership business are liabilities of the partners owners. Are separate legal personality. Over time, the government was pressurized to recognize the need of some partnerships, especially professional partnership, accountancy, or solicitors, auditors, to limit their liability and have a separate legal personality without having to form a company. This resulted in the limited liability partnership because the audit firm business cannot be registered as a company. They can be registered as a partnership. So partner can limit their liability by registering limited liability partnership. Limited liability partnership have similar feature of private company. For example, their members mean owners, i.e. not called partners, are not directly responsible for the debt of the partnership. How limited liability partnership can be incorporated. Incorporation document must be delivered to registrar stating a name of LLP, like a company, location and address of the registered office, name and address of members, and minimum two partners should be in LLP. Must send a declaration of compliance that LLP satisfy requirement of the Limited Liability Partnership Act 2000. And registrar issue a certificate of incorporation like they issue for the company because after this certificate business will be able to perform transactions. Members, first members sign incorporation document, Later members join by agreement with the existing members. Mean in general partnership, normal partnership, if one member is leaving, partnership will demolish. But in case of LLP, if one partner is leaving, the partnership business will continue. Membership ceases on death, dissolution, or in accordance with agreement with other members. But when any of the partner is becoming dead, then this LLP partnership business will be dissolved. But if one member leaving, other joining, in that case, this partnership LLP will continue, not general. Rights and duties are set out in membership agreement. Mean which partner is having what kind of rights, that will be agreed in membership agreement. If no agreement governed by limited liability partnership regulation 2001, then the partner will be having the rights as per the limited liability partnership regulation 2001. Each member act as an agent of the LLP, like normal partnership. In LLP, every partner will be agent of the business as well as other partners. Designated members perform the administrative and filling duties of the LLP. In who will work in the business, that will be decided. Incorporation documents specify who they are. Mean in corporation documents that you are going to submit to the registrar, there will be mentioned who will run the business, who will work in day-to-day activities of the business. Must be at least two designated members. If there are none, all members will be designated members. Mean at least two members must be there. Name must end with limited liability partnership LLP. In the partnership name must end with LLP. Through its name, it will be identified that it is a limited liability partnership. Rules on choice are the same as for companies. In all companies, rule will apply on LLP as well. Taxation members are treated as if they are partners carrying on business in the partnership, i.e., they pay income tax, not corporation tax. Companies pay corporation tax on profit. But in a partnership, either general partnership or LLP, they pay income tax. Mean partner will pay tax on their income rather than on the profit of the business. Because company is a separate legal entity, so company pay tax on profit of the company, mean that is called corporation tax. But in case of partnership, business will not pay tax on profit of the business. Partners will pay profit on their income. Registers, the LLP must maintain the following registers. Register of members, like company, they need to maintain. Register of members, usual residential address, mean what are the address of the members, partners, that must be included in the register. And register of people with significant control who are controlling the business, their register, mean that register must also be prepared. The LLP can keep these registered at its registered head office or choose to send the information to the registrar of companies to be kept on the public register at a company's house. Like a company, they need to maintain, keep these registered within the registered office, or they can submit to the registrar in company's house, mean these register will be kept over there. Liabilities for debts, who will be liable for debt? Business. The liability of members of an LLP to contribute to its debts is limited to his or her capital contribution only. However, there is no requirement for a capital contribution, and any contribution made can be withdrawn at any time. If an LLP goes into liquidation, the court can order the members to repay any drawings made in the previous 2 years if it can be shown that the member knew or had reasonable ground to believe that the LLP was unable to pay its debt at the date of withdrawal. I mean, if companies LLP assets value is 100,000, but company on a liquidation need to pay 120,000 to creditors. In that case, 100,000 will be paid by selling asset. For remaining 20,000, whatever were the drawing of the partners in last 2 years, they need to contribute according to those drawings, not more than that. Would become unable to pay its debt because of its withdrawals. The fraudulent and wrongful trading provisions of apply to members of LLP in the same way as they apply to directors of company if partners were involved in fraudulent activities and company suffered losses and company need to pay its debts. In that case, partner personal property will also be used to pay the debt. If normal activities, not fraudulent activities, then only amount of investment. Difference between LLP and partnership. I mean normal partnership and limited liability partnership. The liability of members in LLP is limited to the amount of capital they have agreed to contribute, while in normal, their personal property will also be used. The LLP must file annual accounts and an annual report with the company's house, while for normal partnership, don't need to file annual accounts. LLP is an artificial legal entity, while partnership is not. And perpetual succession, we will continue. Even partners are coming and joining, leaving. No, normal partnership will come to end. It can hold a property in its own name, while in normal partnership with partner's name. Enter into contract in its own name, create a floating charge, sue, and can be sued. What is floating charge? There are two types of charge. One is called fixed charge. And the other is called floating charge. Company can obtain a loan from the bank by keeping some of the asset as a security. If company holding fixed asset, mean non-current asset as a security against the loan, that is called fixed charge. But if they are keeping their inventory, that is not fixed, that is floating, keep moving, keep changing. So they can put their inventory as a security. So that is called floating charge. So only companies are having both fixed and floating charge, while partnership are having only the fixed charge, not the floating charge. They cannot keep their inventory as a security. As LLP is working as like a company, so they are having a floating charge. I mean, if they have obtained a loan by keeping their asset as a security, so bank can sue the business or recapture their asset that they put as a security. What's the difference between company versus a general partnership? Not LLP, general partnership. Company created by registration with our written constitution. Mean company registration is compulsory. They need to submit some documents for registration. What could be those documents? We're gonna discuss later on. While partnership, no special formality required. for creation. They don't need to put any documents. Company is a separate legal entity, mean artificial person in a society and can be sue or be sued and contract with its own name. Well, partnership, not a separate legal entity. The partners own any property, jointly liable to contract and are liable if sued. Mean third party can sue to the partner in case of partnership. While in case of company, third party can sue to the company rather than owner or directors. In a company, shares are transferable. In share can be transferred from one shareholder to another. Company will remain same, perpetual succession. However, the articles of private companies usually restrict transfer, but the private companies cannot transfer their shares easily. While in case of partnership, limits on a transfer of shares may require dissolution of partnership or consent of other partners to enable partners to realize their share. Mean with the consent of all the partners, one partner can sell its partnership share. Otherwise, if all partners are not willing and one partner want to sell his share in the business, partnership business will be now you need to sign new partnership agreement either with a new partner or only with existing partner. Company can create both fixed and floating charge as a security for borrowing. While partnership can only create fixed charge as a security for borrowing, more usual to have personal guarantees of the partners as well. Not only they need to put asset as security, they need to provide some personal guarantees as well. Company managed by directors who may or may not also be shareholder. Well, partnership is managed by partners who are the owners as well. Company cannot usually return capital to its members. In whatever the investment invest into the company by the owners, company never ever pay back that amount to the owners. If owner want that amount back, they need to sell shares in the stock market. They cannot ask the company, okay, take your share back and give our money back. No. While in a partnership, partner can take their money back. They can withdraw their money. Company is liable for its debts. No personal liability of shareholder beyond any unpaid portion of the price of their shares or the amount they have agreed to contribute. Mean only their amount of investment will be used to pay off the debt, not more than this. While in case of partnership, your personal property will also be used to pay off debt the company. Company must make information about financial affairs and ownership publicly available. Mean they need to prepare financial statements. They need to prepare annual reports where they need to show all the details of the company. While partnership, private businesses, no disclosure of results are required. Company, the business is run by the directors. Members have no right to participate. While in partnership, partners are running the business. They are managing the business. Company must comply with Companies Act 2006 requirement concerning meetings, special resolution, filing accounts, and annual returns. While partnership, no administrative requirement regarding meetings or resolution, but partnership business you need to run as per Partnership Act 1900. Company formal dissolution procedures known as liquidation mean death bankruptcy of any member director does not dissolve the company. If company need to be dissolved, there are some formal procedure that company need to follow. Well, in a partnership, on the death of any of the partnership business will automatically dissolve. There are no formalities. If partner decide, they can dissolve the business anytime. Companies pay corporation tax on profit, while partners pay income tax on their income rather than profit of the partnership business. Can you try this MCQ number one? X limited, Y limited, and Z limited. Three separate legal personalities formed the XYZ partnership, general partnership. There are three partners: X limited, Y limited, Z limited. If the partnership should become insolvent, which of the following statement is correct? The shareholder of each company are fully liable for the firm's debts? No, these are separate legal entities. X limited, Y limited, and Z limited are fully liable for the firm's debt? Yes, because they are separate legal entity, mean artificial person in a society. Partners, who are partner? X limited, Y limited, Z limited, they are partner. In case of partnership, who will be liable for the debt? Partners. The directors of each company are fully liable? No. The liability of X limited, Y limited, Z limited for the firm's debt is limited to the amount of their capital contribution. No, in a partnership, liability is what? Unlimited. And X limited, Y limited, Z limited mean artificial person. These are three partners, though these are companies, but they are partners. So they will be treated as person. Can you understand this? Number two, please. Company limited by share. We cover a topic we are going to cover types of companies. Company limited by shares mean where liability is limited up to the amount of shares in investment. So in relation to E limited, a company limited by shares, which one of the following statement is correct? The liability of the company and its shareholder is limited. Company liability is limited. No, company liability is unlimited, but shareholder liability is limited. But the directors are fully liable for the company's debt. No, directors never ever. Company will be fully liable. The liability of the company and its director is limited, but the shareholder are fully liable. No, in a company, shareholders are not fully liable. They are liable up to the amount of investment. The liability of the company, its directors and shareholder is limited. No, company is liable for full. The liability of the directors and shareholder is limited, but the company is fully liable for its own debt. Number three. Mr. X owns share in Y Limited. Y Limited is a company. This means that Mr. X is a part owner of Y Limited. Yes. Is a part owner of Y Limited's property? No, property of company is property of company rather than owner. Which option is correct? One only. Just take a Break after break.